All right, today we're diving deep into Michael Saylor's pretty radical vision for the future of finance. We're talking about a world where Bitcoin isn't just something you buy and hold, but it's the actual foundation for a brand new type of credit system. So let's unpack how Saylor thinks Bitcoin is about to completely rewire, well, everything.
Saylor kicks things off with this quote, and it really sets the stage. He's framing his whole argument not as some hot market trend, but as this massive, unstoppable force of nature. This is the perspective we need to have for everything that follows.
Okay, here's our roadmap. We're going to start with this fundamental split happening in the digital world. Then we'll get into why all the big Wall Street players are suddenly jumping in. After that, we'll look at the actual credit products being built, uncover this kind of magical tax loophole, and then finally, see how this is all aimed at completely rewriting the rulebook.
So, let's get right into the core of Saylor's whole thesis. He believes the entire digital asset industry has basically broken in two, splitting into these completely separate universes.
Here's how Saylor sees it. On one side, you've got digital capital. And for him, that is only, and I mean only, Bitcoin. Its job is to be a store of value like digital gold. And what's the killer app for gold? It's always been credit that's backed by it. Then, on the other side, you have digital finance. This is literally everything else. Tokenized currencies, tokenized stocks, bonds, real estate, you name it. Two totally different worlds with two totally different goals.
So, the big question is, why is this idea suddenly catching fire right now? Well, Saylor points to one massive catalyst: the unbelievably fast and dramatic change in how institutions are thinking. It's a complete 180 from just a year ago. I mean, just look at how fast things have moved. A year ago, we were deep in a crypto winter. Regulators were shutting down crypto-friendly banks, and Wall Street was terrified. Then, after the election, you get some much more positive guidance. Fast forward to just the last few weeks, and you have major banks totally reversing course. And the cherry on top, S&P just gave its first ever credit rating to a Bitcoin treasury company. The ice isn't just thawing, it's shattering.
And let's be crystal clear. We are not talking about some fringe players here. These are the biggest, most conservative, risk-averse institutions on the planet. JP Morgan, Bank of America, Morgan Stanley, even Vanguard, who famously said never, is now getting pulled in because their own indexes are starting to include companies and credit products backed by these digital assets.
Okay, so with the institutions finally on board, how is this vision of digital credit actually being built? Let's take a look at the pretty sophisticated financial engineering that MicroStrategy has been up to. You know, they didn't just stumble upon the perfect product overnight. It was an evolution. First, they launched Strike, which gave you most of Bitcoin's upside with very little downside, plus a nice dividend. Then came Stride, which jacked up the yield for the real believers by removing some of the protections. And each step taught them what the market was really looking for.
And all that learning led them here, to Stretch. The goal with this one was super simple. Create something that looks and feels just like a high-yield money market account. They engineered it to basically strip out all of Bitcoin's crazy volatility and long-term risk, leaving behind this really stable, high-yield product that pays you a cash dividend every single month.
Saylor has this great analogy for it. He says it's like taking a barrel of crude oil, this raw, volatile, powerful thing, and refining it down into pure, stable, high-energy jet fuel. It's the product of some really intense financial engineering.
Okay, now this is where things get really interesting. They made this unexpected discovery along the way, something Saylor himself calls a magical thing that just completely supercharges these yields.
Just take a look at these yields. A bank savings account gets you, what, basically nothing? A good solid corporate bond might get you 5%. But Stretch, it's offering a tax-equivalent yield of around 17%. That means to get the same amount of cash in your pocket from a regular investment, it would have to yield 17%. So how on earth is that even possible?
Well, here's the magical part. Normally, when a company pays a dividend, it comes out of their profits, and you have to pay taxes on that income. But here's the trick. This dividend is actually funded by issuing new shares. Because of that structure, the IRS doesn't see it as income. They see it as a return of capital. It's like they're just giving you a piece of your own original investment back. And that makes the whole payment completely tax-free.
And that little piece of tax code is an absolute game changer. All of a sudden, a 10% dividend is the same as getting a 17 to 20% taxable yield, depending on your tax bracket. That's an advantage that traditional finance just can't compete with.
So let's zoom out and look at the grand vision. What's the real end game here? For Saylor, this isn't about one crypto competing with another.
No, this is about competing with the entire financial system of the 20th century.
Saylor frames this as a battle: digital credit versus 20th century credit. He argues that the old system is built on what he calls crumbling assets, things like hardware that depreciates or currencies that are constantly being debased. The whole point of digital credit is to build something smarter, faster, and stronger on a perfect foundation of digital capital.
Okay, a fair question then is this just for crypto geeks and big institutions, or can a regular person actually get in on this?
The answer is it's designed for literally everyone. These things trade on the Nasdaq. You can put them in your 401k or your IRA. They're on apps like Robinhood. They are fully compliant. They're rated by S&P. They're built to slide right into the existing financial system, which gets rid of all those typical hurdles to getting into crypto.
And all of this brings us to the final, really provocative question. If this really is the future, when is the right time to start paying attention?
And Saylor's answer is one you won't forget. His point is that if you wait for the entire financial world to give you the all clear, it's going to come at a very, very steep price. It really leaves you with a powerful thought. What's the cost of waiting for permission versus seeing the opportunity for yourself?